You may remember from my last video where I shared the story of Lester Moore. Les was an expert coin flipper during the Great Depression, and what really did Les in was the sheer number of coin flips that he performed. See, anytime you just have a 50% chance of being correct, the more times that you perform that particular task, the more likely it is that your outcomes are going to gravitate toward whatever that mean average is, in this case 50%. So the more he attempted that, the less likely it was going to be that he would be able to beat that average. And that's what we find in the investment markets a lot when people are buying and selling investments. But today I'm going to show you how to take that 50% chance of success all the way up to 100% chance of success simply by applying 3 important principles of investing. But now notice that I mentioned investing, not speculating. So many different people that are investors, or they think they're investors, they're really nothing more than speculators. And it's not just amateur individual investors who are trying to manage their own money. The pros fall subject to this as well. We can see, if you look at the investment market, specifically with mutual funds, that so many mutual funds actually fail or get merged with other mutual funds because they can't outperform or even keep up with the averages. Take a look at this little statistic right here. This goes back for 15 years through the end of 2016, and it shows that only 17% of mutual funds that were in stocks were able to beat their benchmark on a 15-year basis. And that was only 18% for bond funds. So even the pros who have all of this education and all of the access to the information, they have a hard time beating the market too. And it's simply because they're playing the same game that Les Moore was playing when he's flipping coins. But I'm going to show you 3 principles here that will help you become a better investor. And when we talk about investors, one of the most successful investors of our time has been Warren Buffett. Warren implements each of these 3 principles, and anyone who follows these principles can also be successful. So let me talk about the first principle, and that is market timing doesn't work. If you try to get in and try to get out of the market at the appropriate times, you have a very high likelihood of missing some of the best days. And just missing a few of the best days over a longer period of time can have devastating results to your investment performance. You can see here, going back to 1990, that if you just took the average return of the S&P 500 for that period of time, you would have made 9.81% total return. If you missed just the best day, that would have gone down to 9.38%. If you only missed the 5 best days in this long period of time, it would have cut a 1.5 off of your overall return and brought it down to 8.21. And if you would have only missed the best 15 days, you would have lost about 1/3 of your overall return, dropping it down to 6.18. And the best 25 days in that 27-year period of time would have cut your performance in half. So trying to time the market is really nothing more than speculating, and that's not what investors do. So with that in mind, let's go to the second principle. We talked about timing the market. The next step is actually time in the market, because the market has rewarded those who have been patient and disciplined. Take a look here at all of these various events that have happened, really going back to 1970. You can see here a long list of different things from all different angles that really had negative, in some cases devastating impacts on the financial markets. But the market always recovered. So someone who was patient and disciplined and who was able to withstand those storms was actually rewarded for their patience. And if we're talking about trying to increase our odds from 50% up to 100%, time in the market is one of the most effective ways to do that. If you just hold an investment for 1 year, your chances of success there are really not very good, somewhere between 50 and 60%. However, if you hold your investments for 3 years, your odds of success go up a lot. They go up even more over a 5-year period of time. And there haven't been very many periods of time ever when high-quality investments have lost value over a 10-year period of time. Now, if you go beyond that to 20 years or 30 years, you find that there's virtually a 100% success rate in people getting positive investment results. But speculators don't hold on investments that long. So that's where the investment philosophies really do add more value over time. Now, talking about investors, And leading us to principle number 3, let's go back to our most famous investor of Warren Buffett. Warren Buffett understands this principle of market timing and how it doesn't pay off, and how holding investments over the long haul pays off. But he also applies this third principle, which is diversification. His holdings are diversified between a lot of different things, from financials to consumer staples to energy to healthcare. Just like everyone else, even with all of his experience and knowledge, he doesn't have any idea what area is going to go well at any given time, because the markets can be fairly random and unpredictable. By having things diversified, you can have each of these things moving in different directions at different times, but the average of all of those together, the weighted return of your portfolio, is a much smoother ride. And it helps to increase your prospects for gains and reduce your possibilities for losses. Diversification is important, but even more important than diversification is allocation. See, diversification is basically not putting all your eggs in one basket, but allocation is like following a recipe. And if you have a good, solid, proven recipe, all you have to do is simply follow it and you'll get the results that you're looking for. When you're building a financial recipe, you have to consider different ingredients, just like you would if you were baking cookies or a cake or something delicious like that. By combining these different ingredients together, you can throttle the risk levels up and down and also capture the upside while hedging the downside, just by adding more or less of these ingredients. And that's really what diversification is all about. So if you'll focus your energies and attention on not trying to time the market, on leaving your investments in the market so you can benefit from time in the market, and properly allocating and diversifying your portfolio, I think you're going to see your results go up a lot. This sounds like common sense, but unfortunately, common sense is not often common practice. So I hope that you'll take the opportunity to take these principles and put them to work for you. I think they'll help you a lot. If you need any help with that, or if you have any questions, let us know. Until next time, I wish you the best, and I'll see you in the next video.